In today's Chill with TFC, my guest is going to start off by sharing how he lost money investing and trading. I know we're not here to learn how to lose money, but there are important lessons to learn to help us avoid it. My guest even divided into stages of losing money. So let's find out how to overcome those stages so that we can move on to growing our wealth. We're going to cover different asset classes, including a REITs outlook for 2022. What should your strategy be at different age and different stage in life? Let's find out if your portfolio is suitable for your current situation. Hello, my name is Andrew and welcome to another Chill with TFC episode. In this series, we talk to interesting people with relevant experience and insights to help us learn from their perspectives so that we can create the life we love and manage our finances well. The last time my guest was on this show, he was sharing with us about REITs, and he has some solid insights because he's a practitioner himself. Apart from being a REIT specialist, he's also a financial advisor who's helped his clients with retirement planning solutions. Once again, let's welcome Kenny Low. 3 different stages to losing money. What do you mean?
Correct. Because when I first started off, it's basically ignorant. That is the first stage, ignorant.
Yeah.
So basically, just listen to the stock tips. You don't know what you're doing. You don't even know how to do the work. You just listen to colleague. Hey, maybe you invest in this stock. Why they'll explain to you why they invest in this stock. Then you just follow. But after investing, then they never tell you that if a fundamental weaken or they want to take profit or they want to sell, they never tell you. That's why you're just holding the so-called money losing that kind of stock. Then after that, you just lose money, don't know what's going on. So that's the first stage, the ignorant, basically without any proper investing knowledge and basically just listen to stock tips. I think quite a number of the retail investor out there, they are in this stage because I am giving a tuition. I'm also giving a webinar. It's quite typical question. From the question they ask, I know that they really know nothing much about investing. They just ask which one good to invest. That's it.
Sounds familiar. That's how I started. I read some blog, I read about this company, and then I invest, not knowing what to do.
Yeah, exactly.
Ignorance. Okay.
Yeah. So after that, I found that this is something is not good because no matter how, I really need to understand how to do the valuation of the stock itself. That's why I go attend some of the courses to understand about the fundamental analysis, technical analysis. That's how I get started. But normally when you attend these kind of courses, the trainer itself, they are rah-rah. They make the whole thing so simple and it's very easy to make money. And that will really boost our ego and also our urge to go and trade. And beginner luck in the investing world is really true. When I first started investing or trading after attending a course, actually the first month itself, I make $4,000. Just within 1 month. I'm so proud, so excited. I told my mother, I think I can quit my job and become a full-time trader.
Right.
Yes, exactly. Then of course, because when you are in a very good winning first started, and you tend to increase your bet. So second month onwards, I increase my position sizing. And end out second month, my total portfolio, I have a net negative 4,000, which means that in 1 month, I lose $8,000. Then from there onward, I start to trim down all my investing or trading. I think something is not right. Okay, so I summarize in that stage. Second stage of how we lose money is basically we know a little bit, but we are not experienced enough. We don't have enough time or honing our skill because normally if you want to become an expert, you take many years. It's not going to, after you attend a course, first year, second year, you become an expert. No. So my conclusion is minimum, we need to hone our skill for minimum 3 years to really understand the market, understand ourselves, and understand our behavior. So that is the second stage, how I lose money.
So first stage is called ignorance. Second stage, what do you call it? Know a little bit.
Inexperience. It's
okay.
experience that count.
Third stage.
Right. Third stage is basically you have experience. All right. Interesting. You also know all the fundamental analysis, technical analysis, and also macro analysis. Everything you can do it nicely. Come out a chart. Check all the financial ratio. Everything all star align. You invest. All right. But in the stock market itself, basically whatever information we learn from the internet, hear from people, read the report from my analysts, they are all lagging data. All right? The listed company, they will show you what they want to show you. They will not show you what they do not want to show you. So, third stage is the fraud. It's a fraud case because at that time I went through all the S chip, China stock in Singapore itself. Basically, after you analyze all the financial ratio, it looked perfect. It's a very good stock to invest. Then from there on, of course, after you identify a good stock, that means you increase all your investment capital there. Then after a while, there is some audit happening. Then the auditor report come out say that whatever so-called cash statement show in the financial report, physically they are not there in China. So after the news come out, the whole stock price plunged and also suspended. I have to write off my whole investment. So the third stage was very painful. I lost close to 100,000 of all this stock, no matter how well I have done my homework. So third stage, we can call it more on the risk management. No matter how good our analysis, the stock market is always right. Right?
What's the fundamental difference between the third stage and the second stage?
The second stage is more on inexperience. I have some basic knowledge, but I don't really understand the behavior of myself and also market enough, or the instrument I trade. For example, if I'm trading crude oil, they are sensitive to certain information, certain news, and certain monetary policy, and also forex. They have a lot of correlationship. So trading crude oil is not just purely based on crude oil price itself. There are many factors that will affect the crude oil price. So from that angle, I need to understand the whole ecosystem, how they're interlinked to each other. So but no matter how much information you do, definitely we don't know what we don't know. So that's why no matter how much we have done our homework on the third stage, if we miss out something, that something can be very crucial and make us lose money. So what is that thing? We don't know.
Yep.
Right? So in order to avoid that, it's important for us to diversify. That's how my diversification come in. No matter how, we will definitely, I say definitely, make mistake in the stock market, in the investing world. The key thing here is when we are wrong, we have to limit our exposure.
Okay.
We were definitely wrong.
So
right?
the conclusion you came to was that diversification is very important because we're talking about these three stages of losing money, still losing money. You have to go through all these three stages, right, before you go to the so-called making money part.
Right. The risk management come in. Once I went through all these three stages, after that, I start to focus on all different asset classes and also see how I can diversify into some of the non-market correlated so that they don't correlate to each other. Then from there onward, my investment portfolio will start to grow.
Okay, so that's how you approach your own investing and how you actually help your clients with their personal investing as well.
Yes. That's why the behavioral coaching is very important when I'm helping my client. I have to keep telling them that diversification, and they don't believe it. Because like 2 days ago, I just explained to one client that for them, they find it too much homework. Because I told them that when I help you to build a portfolio, I will build a portfolio consists of about 20 REITs. They say, wow, 20 REITs, how I'm going to monitor? You just tell me 1 or 2 REITs, then I'm done. Right? I tell them, no. If you want me to help you to manage, I can never buy you 1 or 2 REITs. If you just want to focus on 1 or 2 REITs, sorry, I can't do it for you. Because I totally understand if something goes wrong, it will go wrong. Murphy Law apply.
You mentioned behavioral coaching. Is that part of your work? How do you do that anyway? How do you coach someone on their behavior?
Yeah, it's because, for example, when the market is very bullish, now typically during this period, because
December rally.
REIT is not doing well. REIT is not doing well. Not saying not doing well, he has been moving sideways for more than 1 year, 1.5 years. That's why some of the investors, they're losing patience, right? Then they forget about what is the primary objective they want to invest in REIT. The primary objective investing in REIT is for the dividend. The capital gain is never come into the picture. It's a plus point. But when they see that some other stock, for example, US S&P 500, they keep going up, they want to switch. It's a typical behavior. Then I told them that now S&P 500 is going at a close to the historical high, right? But as a retail investor, you want to chase that one. Why don't you just wait for a REIT? Eventually, REIT will continue to go up. There will be a rotation. Because when something becomes more and more expensive, too highly valued, there will be a switching from the highly valued stock to maybe so-called undervalued stock. So there will be the rotation come back. We just need to be patient.
Because US growth stocks and REITs, they serve different functions in your portfolio, right?
Right.
And that's why you need to be diversified. So, in your opinion, what makes a diversified portfolio?
Diversification, okay, basically is I start from an asset class. In the investment place, then most of retail investors, they only know about stocks. But we have a bond market, we have the alternative investment market. REIT is considered alternative investment. And we also have the private equity and also some of the debt fund, right? Cryptocurrency and digital fund. There are many asset class over there. You can have some commodities, some futures. There are many there. So when the stock market going higher and higher, the retail investor, they start to lose a patience because they find that, okay, if I don't invest now, FOMO, fear of missing out. If I don't invest now, I'm going to lose out. But they always forget about it. Hey, there are some other asset class undervalued, they are not moving. Actually, you can park your money there first because eventually the rotation you come back at one day. So diversification on the different asset class is very important, and don't put all the investment to pure stock market, 100% equity, because when the market crash, no matter what happened, the whole thing you crash. This happened to most of the investor. They find that they always treat the stock market as a homogeneous, right? When it going out, it has to be one direction. But if you look at it, based on the different geographical diversification, at the present moment, US is getting higher and higher, all-time high. But you look at China, they are more or less a rock bottom. So eventually, the fund, the money, you'll be rotate from the the US, the developed market into the emerging market, right? Because you look at the valuation itself, because fund managers, they are not stupid. They can see that China is very cheap at the present moment, and the business still intact. For example, Alibaba, Tencent, we cannot live without them. But at the present moment, of course, the sentiment is very bad there. So as the investor, maybe especially professional investor, we always have a very long-term horizon, right? As long as business continue to do well, the business is intact, there is a demand. There's a demand on the services, and there is a strong GDP growth. You don't really need to worry too much. Just park our money there. After that, just need to manage the portfolio volatility and let the time to do the wonder.
Of course, you need to factor in political risk in that case, right? Could you give us more examples of how does the rotation play out? You give us an example of US versus China companies. So across different asset classes, right? How does this rotation play out?
Okay, basically there are two things to move the stock market. The first thing is the monetary policy, the interest rate. Because interest rate basically is like you press your accelerator or you jam brake, right? To prevent the economy from overheating, or you want to add some fuel in the economy itself. So when the interest rate going up or coming down, basically there will be a reallocation of fund. Because for example, when the economy is overheating, basically all the growth stock will probably you have start to correction when they start to increase the interest rate.
Cost of money is getting higher.
It's getting higher because growth stock normally they just borrow a cheap money to expand aggressively. So they'll slow down the growth stock. When the growth stock start to the growth start to slow down, some of the fund manager, they'll start to rotate the money into those dividend stock, those value stock. Because value stock, basically, you don't grow too aggressively, but at the same time, they still give you very good dividend. So the monetary policy will play a part in this kind of rotation, right? And also, when interest rate goes up, your bond price will come down. In order to prevent you lose money in the bond space, the money will flow up from bond to move to maybe some equity or move to some short duration bond. There will be some movement definitely, right? But all these things will happen before the actual thing happen. That's why you call it price in. When there's a news, when there's a prediction, the fund will start to move around. Okay, so that is the number one, interest rate, monetary policy. The second thing you'll be due to the business profit, the growth, and also the earning per share or the cash flow generation for the company itself. As long as the company continue to do well, they are able to generate cash flow, generate profit, the stock price will be going up because due to the cheap valuation eventually. So these are the only two things. So if you look at all the business, they always look for opportunity. The fund manager always look for opportunity that those stock which fundamentally strong but undervalued, they'll go in to park the money there. We call it in the investment world, call it smart money.
Tell us more about this smart money.
Smart
What is
mon-
it called smart money in this case?
Okay, smart money, they are not like the retail investor. Smart money, they don't look at too much on the technical analysis, right? Because you don't trade based on momentum. Basically, they just look at whichever sector which have a highest growth potential, maybe in the next 1 year, 2 year, 3 year, 5 year, there tends to be a much longer time horizon. And they just park our money there and just waiting for opportunity and wait for it to grow.
Okay. So that's at the institution level, right? Smart
Institution
money, right?
level, yeah.
What does a retail investor do? Because, okay, hearing what you just said and having this knowledge, right? I know I need to diversify. But like you mentioned, there's so many asset classes. If I really diversify, each of them maybe less than 5%. And there are different schools of thought. One is like, you diversify. And the other one is like, okay, you got to have high conviction, and that's where you get the most growth. How do you reconcile all of this as a retail investor when my funds are limited?
Yeah, it really depends on the risk profile because retail investors, typically there are two types. The first type will be momentum. They just continue to chase. They read the news when there is any stock goes up, they start to chase. That's one group. But it's quite strong that one because you have to monitor the market and you have to look at the news and a little bit gambling over there because you never know. And by the time the news come out, most of the time it's a bit late to retail investor, right? Just beware that there's a news manipulation out there, all right? So second group of investor, basically they are so-called a value investor. Right, they do all the homework. They find that this stock is undervalued, fundamental is strong, and they're used to be trading in that kind of PE ratio or price to book ratio. He has done it before, but at the present moment, due to whatever reason, maybe due to political reason, or maybe due to sentiment issue, or due to suddenly there's maybe the Omicron or COVID-19. Those are the one-time event. Those are some noises. So this is not detrimental to the business. And it's not causing the damage to the business model, it's only noises. So if the retail investor able to differentiate what is a fact and what is a noise, they should be able to identify an opportunity. Then they just need to allocate some of the fund there and just wait for it to recover. Of course, you're not going to deploy 100%. Maybe you just deploy maybe 25% first. Then wait for a while to see whether it recover or not. If not recover, you can deploy another 25%. We call it dollar cost averaging to enter in different phases. Because you also don't want to get all your money get stuck down there because the timing is very important. You don't want to wait, deploy your money 100% then and wait for 2 or 3 years. Then at the same time, you lose out a lot of opportunity. It's the opportunity cost of parking your money there.
Are you talking about deploying 25% in equities as an example?
For example, if you have identified a certain equity which is undervalued and business model is strong, is good, so you have total portfolio design, you have decide to maybe allocate maybe 10,000 into this share, right? But you do not know when this one can recover. You just can deploy 2,500, park it there first. Maybe 3 months later, you look at the whole situation again, you park another 2,500. And after that, you also can look at the chart itself. When they start to, the stock price start to goes up, you deploy the remaining.
Okay. Is there a strategy for this kind of investing style?
That's the strategy.
Okay.
But
is there a name for it? I mean, it's not really dollar cost averaging. You have like one lump sum and you divide in 3, right? 3 tranches.
It's my strategy.
It's your strategy.
My strategy.
Divide by 3 into 3 tranches, depending on the market, right?
Yeah, it's my strategy and also how I manage my client money.
Okay.
Because to balance the opportunity cost of waiting, and at the same time, I will also want to capture the maximum return, right? When the stock price is at the bottom, right, that will give you the maximum return. But the problem is you do not know when they're going to start to rally. But I do not want to miss out the opportunity because for me personally, last time, I tend to wait for the whole confirmation, technical analysis confirmation uptrend before I can deploy. Then you miss out opportunity. Right. Because for those undervalued stock and also a stock with very strong fundamental, when the fund come in, retail investor cannot move the market. When a fund come in, that means a big institute come in. Suddenly you have a spike in the share price. You're gonna miss an opportunity.
The GameStop people will disagree, but yeah.
Yeah.
But I get what you're I get what you mean. I'm just
you get what I mean, right? You
just
get
trying
what I
to say
mean,
something
right?
yeah, interesting.
So these are the lessons learned. After that, okay, I don't want to make that kind of mistake, but I also don't want to get all my money stuck down there. So I split into a few tranches.
Okay. Because you cannot time the market.
I cannot time the market.
And if you wait at the sidelines, patiently waiting, you might miss out, right? And so you put in one tranche first, you observe the market. It either goes sideways, up or down.
Yeah.
And then after that, you put in your second tranche and then your third tranche.
Yeah. And also that one give me the flexibility to adjust if the market change. For example, if it goes up, then it's okay. I can deploy the rest of my fund. What if the market continue to go down? At least I still have a bullet to buy something at a cheaper price.
Yeah, buy the dip. Buy the dip, right?
Yeah. Because sometimes you really don't know. Because for example, recently Alibaba, right? The downtrend has stopped. After that, moving sideways. Then suddenly, some of the news, okay, nothing to do with Alibaba. It's like the Didi.
Yes.
Right? They said delist.
Delisting.
Then Alibaba also affected. It come down and around again.
Yeah. So there's this meme which is they asked me to buy the dip, but the dip keeps dipping.
Correct.
That's a possible scenario.
That's
but
a possible scenario.
If you believe in this case, you believe in the long-term fundamentals of Alibaba, right? Then you don't mind buying at cheaper price, so to speak.
Right.
It really depends.
Exactly.
Okay.
Yeah.
So you just describe investors in two types. One is momentum, one is value. Let's dig a little deeper because I'm sure there are different angles to look for. For example, your age. Which life stage are you at? Let's get a little bit more nuance. How do I diversify my portfolio? Let's stick to the team, right? How do I diversify? And it depends. I'm sure there's no one size fits all.
Yeah.
Right, but let's go into the details of it.
Yeah. For those who has a longer runway, for example, fresh grad, just graduated, you have but you don't have a lot of money, right? You don't have one lump sum of 100,000.
Early 20s.
Maybe you have 20,000 and every month you have free cash of about $1,000, $2,000.
Monthly income. Right?
Yeah. Then it's better to use the monthly saving plan. That means you invest regularly every month, consistently 1,000, 1,000, 1,000, and you can choose those stock or unit trust or ETF tends to be more aggressive, right? And of course, you need to choose the right stock. You don't want to choose something that over the long term, the business model no longer valid and the share price will go to zero. You try to avoid that kind of happen from happening. So invest consistently, go for aggressive growth portfolio over the long term using dollar cost averaging strategy. Basically, your weighted average purchase price will be lower. You definitely you gain the long term appreciation on the stock market itself.
Okay.
So can go aggressive for the younger.
So for this profile, right, younger, more runway, more time, right? You can be more aggressive. So roughly, as in to get a sense of how to diversify the portfolio. How much? What's the percentage?
Okay.
Yeah, roughly.
If you have 1,000 every month, buying the individual stock cannot give you any diversification. For example, you buy a REIT, right? Because minimum in order to buy a REIT is near 100 shares. So in order to do that and also have a very, very diversified portfolio, it's better to use the unit trust. Okay, because unit trust, the minimum investment amount for some of the fund, for example, China team, you just need $250 per month. You can have a China exposure. It can be 50 or 100 stocks there. All right, and maybe another 250 you can diversify into using the technology fund. Then you can have access to Apple, Microsoft, and those things. You don't need to fork out the full amount. Then another thing is coming very hot moving forward. You'll be all the ESG, environmental, social, and governance.
Oh, okay.
Right, and this is a regulatory requirement. It is going to happen, and I can see that this will be the good team moving forward, especially the younger generation. They are more environmental conscious, right? You just allocate another $500 to this kind of ESG fund, right? Do good to the society, do good to the earth itself. So you are basically 3 fund. You have more than 100 stocks underlying there already. Instead of you just focusing on Singapore stock, one stock.
Okay. So moving on to the 30s, that's where most of our listeners are at. Well, 30s is interesting. You're relatively young, but you might be getting married, you might need to buy a house, you might have children, young children. How do you diversify?
Right. Okay. Actually, have to be more defensive a little bit.
Defensive, okay.
A little bit more defensive because at any one time, you do not want your investment to be locked out, and also you need to prepare the liquidity. When you need money, you can liquidate, you can sell.
Yeah, I need to pay your mortgage, for example.
Right. So it's important, don't get your investment locked up. Okay. For example, using the insurance ILP to invest may not be a good idea if you need the liquidity. Right. And timing of a market is important. You don't want to sell when there's a bear market. So it's better to have some of a portfolio tends to be more volatile, underlying more volatile, but it'll give you the maximum growth, right? Then some of the portfolio tends to be less volatile. For example, you can allocate into some of the bond fund, or maybe REITs tends to be less volatile. At the same time, they also can give you some dividend. Not fantastic, 3, 4, 5%, right? It's also good enough. It's still better than parking your money in the bank, right? The interest rate in the bank at the present moment, 0.5% or lower. I saw the latest inflation number, 3.2% annual inflation rate in Singapore. It's pretty scary. So if we park the money in the bank doing nothing, definitely our purchasing power will be eroded.
Okay. How about 40s and 50s? Is that where more REITs come in? Because that's our topic when you last came on the show.
Yeah. So 40 and 50, we are getting closer to the retirement. Definitely, we do not have a long runway, and at the 40 itself, basically we are entering into a midlife crisis. It's quite easier to lose our job. When we lose our job itself, if you need the money, basically, we have to get our money from somewhere. Maybe need to liquidate our investment portfolio, right? So it's better to be slightly more defensive, more dividend stock as the so-called cushion, right? Because if one day we lose our job, we are still able to rely on our dividend as a passive income to feed our family, to feed our money expenses. So dividend stock should be the bulk of it. Of course, 40 years old still quite young, right? If they are if they are able to take a little bit risk, maybe 20 or 30% allocate into growth stock. Because if you do not have enough for your retirement, you definitely need to make full use of growth stock to help you to grow your portfolio when you venture into retirement. Right?
Okay, all right.
Now, when you go to as a retiree, okay, as a retiree, because I saw some retiree, I do not know why they are still spending so much time go and trade all those penny stock. Maybe for entertainment. But if they're trading for retirement, this is something not so right to me.
I mean, just a story, right? So my friend's dad retired recently. Same thing, signed up for some trading course. You know, my friend was so angry because, I mean, from her opinion, the course is obviously out to cheat money. But that's her opinion about the course, right? Not all courses are out to cheat money, of course. But the thing is, maybe you just need to do something at the age, you know, to have something to, you know, still to look forward to.
Yeah, they can do something. But first thing first, as a financial advisor, I always recommend and advise this group of retiree. First thing first, you can trade penny stock, trade all the meme stock, whatever stock you take high risk, go ahead, because there's an entertainment. Because when you retire, got nothing to do really. You cannot possibly go every day go and play golf, and not many people also like to play golf.
It might not be fully entertainment though. For my friend's father's case, right? Although there's some base level of wealth to draw from, but the idea that no income is coming in. So assuming you're retired, right? Really no job income, right? When no income is coming in, right? You might not be used to it. It might feel a little bit scary at that age.
Yeah. I tried to become a full-time trader before. It's quite scary. Okay. You set target every day. I need to make $500 from a stock market. And that target will kill you because you end up you're over trading. If you're making money, you just look at a few scenarios. If you're making money on the day itself, you find that, today is my day. I'm so invisible. After I make a 500, I think that today, 很顺. Let's go bigger. Right? Maybe you end up losing, right? Now, the other scenario, if today is not your day, you're losing money. But you need to make 500 off the stock market, no? Otherwise, how to feed your whole day, man?
Pay for your expenses. Yeah.
So there tends to go and overtrade again. Then you lose even more money, right? And the third scenario, the whole stock market itself, there's no signal for you to trade. It's very boring, right? Because sometimes no signal means no signal. You cannot force yourself to trade.
They have to do something.
Yeah, do something, correct.
Right.
And you have a $500 target to meet. Then you end up no trade, you also force a trade. So psychologically, it's really go haywire when you become a full-time trader. But in order to solve that problem, now we change it to another scenario. Let's say that you have already have the passive income portfolio, which are able to really fit your money expense, give you 4,000 passive income. Okay, then you do become a full-time trader. Your psychology is totally different.
Yeah.
No opportunity to trade doesn't matter because I have 4,000 coming in for my passive income portfolio, the dividend portfolio. So for the retiree, they should first thing first focus on building a passive income portfolio. Then the remaining money, go and do whatever thing you want. You can take risks because you can afford to lose.
Yeah, that makes sense.
Right.
Because as an investor, you really have to overcome some form of psychological biases that you have. As a full-time trader, it's even harder. But of course, some people's temperament suits that. Some people like it, right? But like you said, it's really overcoming your own psychology.
Yeah. But to tell you the truth, the successful full-time trader, they always have a passive income portfolio with them.
Okay.
Always. Nobody go and put the whole retirement portfolio just 100% to trading. No one. Because it's the reward versus risk, that kind of calculation.
Right. If you have to pay your monthly expenses purely by your trading income, that's going to screw up your psychology a lot.
Right.
You're forced to do a lot of things that you might not normally do.
Yeah. For those full-time traders, maybe they just first started off with very limited capital that do not have a passive income portfolio. It's very common for them is whatever money they make from a trading portfolio, they'll take out some portion, go and build a dividend portfolio. It's a very, very common practice. Right? To safeguard what you have at the same time to give you a passive income so that you less rely on your trading portfolio. And trading is a full-time job, right? You have to sit in front of a computer unless you use the robot to help you trade, algorithm to help you trade. It's not free. You have to pay for all the subscription. You have to pay for someone to help you to write those scripts. It's not free. So those are really professional traders. And how many of us can make it? As a professional trader, it's not easy. Okay. I've tried before. I tried about 1 week, I gave up.
Did you get burned or was it just too tiring, too taxing?
It's too taxing because there are certain market we can trade, certain market cannot trade. Okay, I just go through with you what happened to me. Try to become a full-time trader for 1 week. 1 week I gave up. Every morning you have to be very disciplined. For example, the morning session, SGX forget about you. SGX you can't trade. Okay, so forget about SGX market. The only market you can trade in the morning, 9 a.m. is either Hang Seng or Japan. Right? That will be between 9:30 to maybe 10:30, that kind of time frame. Okay, because after a while you go to lunchtime, it's very boring, not moving anywhere. Because trader like volatility. You want big swing up and down. This is how you make money, all right? But before the 9:30, the market open for Hang Seng itself, you have to do a lot of homework. Then after you finish preparing your homework, you trade during that period. If you don't have trading signal, basically you just doing nothing. Okay, that's the first period. Then the second period will be probably our dinner time when the European market open, right? Maybe between 5 to 7 o'clock. Okay, so the second period. And the third period will be the US market. It'll be 11 to 12 a.m. or 1 a.m. But you just look at your own timing. Your own timing all screw up. No?
Yeah. Day and night is opposite now. Yeah.
Right. You don't live a normal life. Don't live a normal life. And also you just look at this trade different market. This trade different market got three different behavior. How do you want to trade? It's not easy. There's so many things for you to trade and so many ticker symbol you have to do analysis. And also there are certain timing, for example, when there is a FOMC meeting. FOMC meeting normally is at 2 a.m. they release a result.
FOMC, could you help us define it?
Federal Open Committee. Basically, it's the committee in US. They organize, I think, 6 meetings per year. They talk about the monetary policy, whether they want to increase interest rate or decrease interest rate, right? And normally they make an announcement in 2 a.m. Singapore time. And before they make an announcement, you don't want to trade because it can be very volatile. It can go anywhere, and those volatility is not caused by human. It's caused by the computer. How the computer do a trading? Basically, they just read the script. Read all the wording and start the algorithm and start to issue buy and call, buy and sell signal
based on keywords and all that.
That's why if you have time to really you monitor before when there's an announcement itself, you can see that the stock market tend to be very, very volatile. And if you're a trader, you set profit target, you set stop loss. This is how you get all the stop loss all stop out.
Going back to our theme of building a diversified portfolio, you mentioned mainly asset classes, but tell us a bit more about country, sectors, different ways of diversifying.
Okay. So for the retail investor in Singapore, probably they only know about Singapore Stock Exchange, right? That's why if they want growth, they always complain about Singapore stock market, no growth at all, right? Then Singapore is only suitable for the dividend stocks. Okay, that is true. If they want growth, they have to look up somewhere. The growth is in Hong Kong because we have a lot of China tech stock there. The growth stock market is in US, right? So if they are not able to don't know the instrument how to diversify to those markets, they'll lose out the growth opportunity. Okay, that's one thing. So it's important, especially in Singapore itself. Now, basically, when we're in Singapore, we are able to trade any place in the world. We can invest any place in the world through ETF, through the unit trust itself. So diversification to different countries is important because you do not want to put everything into one basket. For example, if you are a strong China supporter, if you put all your portfolio, all your stock allocation into China, then you get hit this year, right? For example, next year, if US is going through the big correction, all the US stock will be hit, right? So it's important to really allocate to different countries, to US, to Japan, to Asia Pac, to China, because at the end of the day, the money in this world, you flow from one country to another country because it's so easily moved from one asset class to another asset class. That's why, for example, when there is a big correction in the maybe stock market itself, the money you tends to move to the bond market or maybe move to the gold market, right, to hedge a position. They will definitely move to somewhere, right? Because the fund manager, after they take profit or cut loss in certain portfolio, they cannot keep the money into cash position because they have to deliver the return to their investor. So they are moved to somewhere safe, but at the same time to give you some dividends, some coupon. So diversification to different countries is important to really, basically you don't react after the market reacts. You plan for it first. If this thing happen, which market you benefit? This is how I plan my portfolio.
So you look at asset classes, you look at countries. How about sectors?
The sector is, especially this year and next year, probably the investor can see a lot of thematic portfolio coming up, right? So technology disruption is one of the theme, right? We are already seeing that how technology changed the world, changed the way we work, how to make us more productive. And now even you can buy the virtual property, right? Amazing. Virtual
Crypto,
property. Yeah,
virtual
you have a
worlds,
crypto.
Metaverse and all that. All
Yeah,
right.
metaverse. So thematic is important. Another thematic will be the ESG play, right? Sustainability play. And China definitely is one of thematic. We cannot run away from China, the growth story. But it may not happen maybe this year or next year. But long term, if you have the investment horizon of 5 years, 10 years, definitely China will be here. And also, due to a supply chain disruption and also the inflation, the commodity space you'll be doing well, right, in this 1 or 2 years. So just allocate some of the fund into this kind of thematic, a pocket here and there. So just write on the capital appreciation. But of course, you just cannot, just after allocation, you just close your eye because it's thematic. Thematic is short term. It's more on tactical play, right, during this period.
Okay. All right. So today we talk about diversifying your portfolio. It really depends on your age, your life stage, and what are your goals, right? And then after you look at country, you look at sectors, you look at different asset classes to build a diversified portfolio because you want to avoid the mistake of, the first 3 stages of losing money.
Yeah.
Okay. And this is how you defend yourself against that.
Right.
All right. So stay tuned to the end of this episode because I'm going to ask Kenny about an overview of REITs in 2022. Thank you for watching this video. If you found it useful, like, share, subscribe, and feel free to leave your comments. You can also join our Telegram group, follow us on social media, and sign up for our weekly newsletter. Everything is in the description. For more content, check out thefinancialcoconut.com. So can you give us an overview of REITs in 2022? What are your views, your analysis? What are you looking out for?
Okay, basically, 2022 is a reopening play for REIT because now you know that all the BTL have being established, the borders start to open. That will really get our business back to normal. When our business get to normal, people can start to travel, the business will start to recover. For REIT itself, definitely they'll be benefiting for this kind of increase on the traffic, increase of business activity. So when the business in the full recovery mode, basically the rental collected, you increase, right? Compared to 2021, basically you have a lot of business shut down, or the lockdown and those things, right? Your dividend definitely will be impacted for the past 1 or 2 years. So in 2022, the return of dividend, you definitely will increase the share price because people want dividend. At the end of the day, dividend is very crucial for those retiree. And at the present moment, this month, the latest number, the average dividend yield for the REIT sector in Singapore is 6%. 6% is pretty high, right? So in terms of the valuation itself, it's just at a fair value. So at the present moment, it's pretty attractive the way I look at it. But of course, different sector will have a different performance moving forward. Okay, so I will start with the hospitality sector first because that comprises of the hotel, service, residential. So next year, hospitality sector, I have the most bullish view on the hospitality sector, right? Because of the increase in tourism, and also we have been locked down for 2 years. That's why immediately I want to go to Singapore and travel.
I mean, if I play devil's advocate, what if more variants come? But then, okay, of course, we are looking at it being 2 years already, and then more BTL openings. There will be some form of reopening.
Right, there will be some form of reopening, and also, if you look at all those countries and all those working adults itself, I think basically they can't afford another round of lockdown. They can't afford, because before the virus kill us, we will be killed by the economy first. We have to feed ourselves first. So I think that no matter how unlikely you go back to the full lockdown, right? Of course, there will be a lot of inconvenience, there are a lot of control, there are a lot of testing along the way, but I don't think we'll go back to full lockdown. So unlikely. This is also another very common question that the investor asked me, will we go back to another market crash or not? Okay, quite firmly I will say no. We will not go back to March 2020, the whole market crash, because now we know the virus much more better. We have a vaccine, we have a test kit, and we are able to really do the isolation, segregation, and treatment much more faster. So things is much more better compared to last time. So hospitality is a good reopening play. And the retail sector is the second one, is also good for reopening play, especially for example, if you look at the Orchard Road, now you can start to see Orchard, all the light come out again.
You mean the Christmas lights?
The Christmas light.
Well, our tourists need to come in.
Yeah, I think they'll come in, but at least you can see that, wow, finally.
Some form of life. Some form of life.
Some form of life. So those retail mall, you tend to do well if more and more tourists coming back. Okay. So retail is a second bullish play, because at the present moment, if you look at historical price to book itself, it is still undervalued, right? It is there, beside the 5% dividend, annual dividend, you still have probably 20% upside potential compared to the pre-COVID. Look at the chart, look at the price to book, more or less you know that what is the future upside potential already. And when you come to data center, don't need to mention about data center. The digitalization of the economy, the rolling out of the 5G system, you definitely need a lot of data. E-commerce also need a lot of data. Data center is here to stay. So that's why you can see that the recent IPO of a digital core REIT itself is so hot. It's so hot, right? Digital data center definitely is a growing asset. I can see that there'll be more and more REIT. You'll be include the data center into the portfolio. Okay, and e-commerce logistic. That's why you also can see that the Daiwa House Logistic Trust, they listed that they pump in, I think 12 logistic from Japan into this REIT IPO itself. So it has been doing well also. So logistic REIT is a growth play, the new economy play moving forward. The only thing that may not have a very good growth prospect will be probably a commercial office, right? Because work from home trend, basically now with the digitalization of the economy, we can work anywhere we want, right? We also can work anytime we want. We don't really need to go back to the office. So my view that probably the performance for the commercial office will be muted, but definitely will not be worse than last year.
Okay. For reference sake, this is recorded in December 2021. So let's hope that in 2022, life goes back to some form of normal. We're all healthy and we all make good money.
Yeah.
Okay. Thank you, Kenny.
Right. Thank you, Andrew.